What if I told you that choosing the wrong mortgage today could cost you thousands over the next 5 years? That is not an exaggeration. It is the reality of today's market. Welcome back to Getting Your Shit Together. If you are a homeowner or planning to buy one soon, this episode is a must listen. We are going to discuss about one of the significant financial decisions any mortgage borrower has to make. Should you go with a variable mortgage right now? You have all probably seen the headlines. Everyone is talking about interest rate cuts. The experts from the big banks predict that the actions of Bank of Canada could see prime rate drop to 4.7% by the end of 2025, while others think we could see prime rate as low as 3.70% if economic conditions worsen. Well, especially with the growing concerns over a US Canada trade war. It sounds good if you're a borrower, right? Banks are saying variable rate borrowers could save about $6,000 in 5 years on a typical mortgage. The scenario they quoted is a typical borrower financing a half a million home with 10% down over 25 years would save about $100 per month. So that would equate to about $6,000 over the 5 years. But is that the full story? Not quite. Let's break this down and figure out whether a variable rate mortgage is the right move for you. Let's start by reviewing how does the Bank of Canada decide its interest rates? While there is no fixed formula or an equation, the Bank of Canada doesn't just change its policy rate on a whim. There is a method to the madness, and it comes down to factors such as these. Inflation. In simple terms, if inflation stays high, rate cuts could be delayed or even reversed. On the other hand, if inflation increases, then the rates also increase. If inflation reduces, then likely rates reduce. Economic growth. A slowing in economy makes rate cuts more likely, while an overheating economy with little surplus capacity will lead to a rise in interest rate. Unemployment. Rising unemployment can result in the Bank of Canada reducing rate to stimulate the economy and to thereby improve the employment outlook. While a low unemployment rate can also indicate an overheating economy, which could in turn lead to the bank raising the rates. Global events, trade wars, recessions, financial crises, pandemic, etc., can also move rates up or down. Now, what I just laid out is a very simplistic theory behind such rate decisions. But the real world is a messy place, and there is little certainty about which way these factors will evolve in future when making these decisions. This results in decision making being very challenging for any central bank. Moreover, these factors do not change in isolation. Inflation can increase while the economy is heating up, or maybe even it is cooling down, like in the scenario of a stagflation. The degree and impact of various events or trends could vary, and the resulting policy actions from Bank of Canada would also vary accordingly. Hence, there is no fixed formula or equation to determine what the prime rate could turn out to be. The key lesson that we learn from history is that interest rates do not stay the same for 5 years straight. They go up, they go down. So when experts tell you that a variable rate is better because rates will fall, what they're not saying, well, at least not loudly, is that rates could just as easily go up before your mortgage term ends. So, given this uncertainty, how do you approach this? I think it boils down to your personal temperament and financial situation. And let's explore this further. So, who should consider a variable rate mortgage? The question to ask is, what kind of borrower are you? Are you an opportunistic risk tolerant saver? And you might fit in this category if you think the current rates are too high and you would expect them to fall. You are convinced that the variable rates historically perform better over the long run. You are also convinced that locking into a fixed rate today could mean paying more over the long run if cuts happen soon. More importantly, you believe you can time the market. When interest rates start rising again, you will convert your mortgage to a fixed rate before it's too late. An example of someone who fits this profile should have a stable income that can absorb short term fluctuations, sufficient emergency savings as a cushion to counter any downside, a close eye on economic trends to anticipate shifts, and finally, the confidence and the discipline to switch to fixed rate at the right time. If the rates drop, you win. But if they start creeping up, your move is to act fast, either by locking into a fixed rate or adjusting your financial strategy. But here's the danger: do not be the frog in boiling water. During the pandemic, interest rates rose faster and higher than anyone expected. Some borrowers held on to their variable rates too long, thinking the hikes would stop. And by the time they realized that the trend had shifted, it was too late. They were stuck with payments they never anticipated. Trends change. Rates do not travel in just one direction. They could shift structurally, meaning what worked before might not work again. So if you see yourselves as a risk tolerant saver, ask yourself, will you truly recognize when it's time to lock in? Are you prepared to act decisively when the moment comes? Because in the mortgage game, hesitation can cost you big time. Now, you could also be a flexibility seeker, and you may fall into this group if you plan to sell or refinance before your mortgage term ends. But maybe the timeline isn't that firm. You want lower penalties in case you do break that mortgage. A typical borrower in this category would be someone who usually prefers fixed rate mortgages, but is choosing variable only because they have a transaction, like a sale or a refinance in mind. Once that transaction is completed, they typically would go back to the same fixed rate for stability. For example, you could be planning to upgrade your home in the next 1 to 2 years, but aren't really sure exactly when. A variable rate mortgage offers lower breakage penalties, making it easier and cheaper to move when the time comes. Or you may want to renovate your home and refinance within the next 1 to 2 years to access the needed funds. Instead of locking into a fixed rate with high penalties, you offer variable to keep your options open. In short, flexibility seekers aren't in the variable rate option for the long hold. They're just using it as a strategic tool until their plans fall into place. But let's be real, variable rates are not for everyone. You should seriously consider a fixed rate if you have a very large mortgage, have tight finances, and cannot afford the risk of rising payments. You prefer or need financial certainty and predictable payments. You're not financially confident and lose sleep over economic uncertainty. For example, maybe you are a young family on a tight budget. The last thing you need is the stress of rising mortgage payments. A fixed rate gives you peace of mind, even if it costs a little more upfront. Or maybe you are retired on a limited budget and do not have much room for any uncertainty. So, what is the final takeaway? Well, the right choice depends on you. And here is what I would suggest. If you're comfortable with some risk and want potential savings, variable could work. If you need flexibility for future changes, well, variable makes sense. If you value certainty, fixed is the safer bet. But do not let anyone else decide for you. Everyone has their own life experiences and resultant biases and their own incentives as well. But you know yourselves best, your mindset, your comfort, your plans, and your aspirations. Do your research, take inputs from a mortgage expert, but make the choice that fits your situation. So let's hear from you. Are you team fixed or team variable? Drop a comment or message me directly. Before you go, a message for the next week's podcast. Well, the tariffs are expected to materialize on Tuesday, 4th of March. So I am going to review the immediate impact on interest rates, among other topics. How could a US Canada trade war affect your mortgage? Will interest rates actually rise? Or are we in for a financial shock? Subscribe now so you don't miss it. Because staying informed is the best way to getting your shit together. So that's it for this episode of Getting Your Shit Together. Thanks for tuning in, and I will see you next time.